about some tax-smart wealth strategies that could potentially impact your financial life. Our panelists are ready to begin today's discussion, but before we do, I do want to mention that Fidelity doesn't give tax or legal advice. So nothing we talk about today should be interpreted as tax or legal advice. The information we provide is going to be general in nature, and it might not apply to your situation. If you do have tax or legal questions about your specific situation, we encourage you to talk to your tax professional or to your attorney. All right, ready to get going today. We've built today's discussion entirely around many of the excellent questions that the audience sent in when you registered. So based upon your input, our panelists are going to be talking about a wide range of things, including but not limited to tax-smart investing, Roth conversions, lots of great questions about that, other Roth strategies, charitable giving, the upcoming election, of course, and a whole lot more. Before we get going, though, I'd love it if each of our panelists could just spend, 30 seconds to a minute or so introducing yourselves, talking about the work you do at Fidelity, and the perspective you bring to today's conversation. So, Michelle, we'll start with you.
Oh, thank you, Jim. I am a Vice President Wealth Planner at Fidelity Investments, and I've been at Fidelity now 20 years, working face-to-face with our clients as an advisor in the branch system. I currently support clients and their families that desire a deeper level of planning and a one-on-one relationship.
Excellent. Thanks for joining us today. Naveen?
Hi, I'm Naveen Malwal. I'm one of the institutional portfolio managers at Strategic Advisors, a mouthful there, but I'm part of an investment team that manages millions of accounts here at Fidelity Investments, including some taxable accounts. Today, I'll be sharing some of the strategies we use to help our clients save on taxes over time.
Super important. Thanks for that. And Sandy?
Yes, I'm a Vice President Advanced Planner here at Fidelity. By background, I'm a CPA, also a certified financial planner, with 39 years in the wealth management business. And here at Fidelity, I educate our clients on financial planning strategies.
Got it. And Sandy, we'll stick with you as we dive right into probably one of the most popular topics, one of the most common questions we got from folks when they registered. Makes a lot of sense, given what's going on in the news these days, the elections coming up in November. Sandy, a lot of people watching right now are trying to figure out what changes, if any, could be on the horizon. So how would you say clients should be thinking about the upcoming election and their taxes specifically?
Sure. So as I have my planning conversations with the clients, many say they want to wait till after the election before they do any additional planning. One of the things we're aware of is that next year, this law does sunset, the Tax Cuts and Jobs Act of 2017, also known as the TCJA. And that could result in potential increases in both income and estate taxes. So for example, if the law does not get extended, we're going to see the estate exemption drop from currently it's over 13 million to over 27 million for a married couple, to 7 to 7.5 million per person, 14 to 15 million for a married couple. And so what I tell clients is if you wait, getting in to see an estate planning attorney could be difficult if you want to do some gifting strategies. So they're going to get very, very busy. So waiting till after the election, it may be too late. So I've also found with many years of planning that I've done that a lot of this tax planning strategies, such as gifting, makes sense for your situation, regardless of whether or not the tax laws change.
All right. So I hear you don't wait for an external event, be proactive, start. If you're thinking about doing it, get to work, right? Don't wait for an external event to prompt you or react to something else. But Michelle, what about the situations in which a client maybe hasn't really incorporated any tax planning into their wealth strategy before? It can seem, well, it is pretty overwhelming to start from scratch. So how do you get going?
Yeah, so first off, Jim, I want to just have a conversation to level set. Where is your comfort level with talking about taxes? Do you have a comfort level in regards to tax planning within your investment strategy? Is it simply just filing your taxes on an annual basis? We may uncover that taxes have been a topic that you have been deliberately avoiding or simply just never realized this was an area that would affect you. I like to assess the client's holdings to help them determine what may trigger taxes now and what may trigger them in the future. I will also discuss the impact of current government policy on their strategy and potential impacts down the road. I will utilize a cash flow analysis. It illustrates what the picture might look like from an income perspective. Lots of strategies that can make a difference. For example, asset location.
Perfect. Okay, I want to pause you there because again, there's a lot of jargon, or there can be a lot of jargon during conversations like this, and you're likely to hear us talking about asset location and asset allocation, which sound frustratingly similar, Michelle, but they're very, very different things.
Oh, they absolutely do, don't they? And so in many of my conversations, again, we'll hit the pause button and we'll say, let's discuss asset allocation first. And this is about dividing a portfolio between asset classes like stocks and bonds, which may have different tax implications. Asset location is not the same as asset allocation. It's the act of being deliberate in where you hold certain types of assets. And what I mean by that, do you hold those assets like a mutual fund or a stock in your IRA, or do you hold them in your non-retirement account, which is exposed to taxes? And I do like to understand a client's preference around this topic. Sometimes it's by luck that certain assets land in certain locations, and other it's by design.
All right. Luck sounds less preferable to design, I think. But in general, another word for that is probably strategy. And Naveen, I'll turn to you now because of the words used in the questions that our viewers sent in, strategy was probably among the most common we heard. I'm looking at some of the questions now. What are some effective tax strategies? A nice general question. I'm looking for a strategy to protect my assets while reducing my tax liability. So can you put some numbers, Naveen, around these types of questions to explain the long-term value of incorporating tax smart strategies?
Yes, to Michelle's point, not everyone has deeply thought about taxes or considered this as part of their plan over the years, and some might think the numbers aren't that big. But let's look at a study from a company called Morningstar. They went back and looked since 1926 what might have been the potential impact of taxes on investors. So on the left side of the chart, you'll see a pair of bars. One is showing you stock returns over that time frame, about 10% a year over that time frame. They're almost a 100-year time frame, so very nice returns for stock investors. Right next to that's another number, 8%, 8.1%, and that is 8.2%. That is showing you what the return was after taxes. So almost 2% of the return they lost to taxes, tax costs. And that 2% might feel small to some people, but another way to think about that is if you take that 8.2 and 10.1 and divide them by each other, wow, that's a 20% gap. So almost 20% of your return has been given away to tax inefficiency by not being strategic about managing taxes over time. The story is even more dramatic for the bond investor. So bonds over time generally do return less than stocks. They're also generally less risky, less volatile as well. But here, bond investors have done pretty well for themselves, generated a little over 5% before paying taxes. But with bonds, they're typically less tax efficient than stocks. So you can see a pretty big drop from what they made before tax to after tax. By over 2%, the gap is there. And again, if you divide one by the other, nearly 44% of that initial gain before taxes was lost to tax costs over time. So those are significant numbers in my mind, and that can compound, especially after years and years of not paying attention to this. That can add up to thousands or tens of thousands, if not more, of potential lost returns that the investor left behind because of tax inefficiency. So a lot of the topics we'll be discussing today will hopefully give investors some ideas on how they may be able to close the gap they see either for their stocks or their bonds or other investments in their portfolios.
Yeah, thank you for that, Naveen. That's exactly what I was thinking as I was looking at that chart. It's stark on the chart, but then when you think about it, played out over decades, it gets even more significant. So, Michelle, I want to revisit what you talked about a moment ago in terms of asset location, where someone chooses to hold their assets. Talk about that, please, and dive a bit deeper.
Absolutely. So this makes me think of many client interactions that I've had over the course of time. Picture it, the beginning of the new tax calendar year, and you as an investor might reach out to me and ask, why are my taxes going up? Well, this is a specific situation where tax location came into play. And I'm going to talk about a mutual fund that pays out capital gain distributions or may have a high turnover rate, may be inefficient to hold in a taxable account. This is because the mutual fund generates taxable income for the investor. Some of these capital gain distributions may create unfavorable tax outcomes for the investor and possibly bumping their tax bracket higher, and for some retirees impacting their Medicare costs. I have been present for many of these surprises in regards to discussions with clients, and it is an unfavorable surprise. So consider holding these assets in an IRA to potentially avoid those capital gain distribution impacts. Individual stocks and ETFs can be much more efficient assets to hold in a non-retirement account. Those vehicles have different turnovers and tax consequences compared to a typical mutual fund.
Thank you for that, Naveen. I'd love to go back to you to talk a little bit more. Again, the word strategy ringing in my head based on all the questions we got from viewers. Talk a little bit more, if you could, about strategies designed to help manage those tax implications inside of an average portfolio.
Sure, and you'll hear a lot more from Sandy and Michelle on this too, but just in terms of managing the investment portion of this, there's a number of strategies an investor can use. Here I want to share a visual that can list just 8 of these strategies that are available. There potentially are more, but I work with over 100 investment professionals here in Boston and in Denver, some in Ireland and other parts of the United States, and dozens of them focus on these types of strategies to help our clients get better after-tax results. There's a pretty long list. I'm not going to detail all of them here on this page, but I can break them up into 2 categories. The first category revolves around setting up the account. So first of all, moving the existing asset of the client, whether it's already at Fidelity or coming from the outside, how can we bring their account in line with a good asset allocation, as Michelle said, the mix of stocks and bonds and other investments, while not incurring a lot of tax gains. So doing that in a way where it does not generate a lot of trades or selling and realizing gains over time. The other piece of this goes back to something else Michelle touched on, is investing in tax efficient investments. So Michelle gave you a couple of examples already. Another classic example is in bond investing. Many bonds are actually tax inefficient. So you pay the tax on the income coming in every 6 months or so. However, municipal bonds generally are very tax efficient. For most investors, they are exempt from federal taxes, and depending on where you live, state, city, they may also potentially be exempt from state and local taxes. So that's an example of tax efficiency. And I agree with Michelle, this is something you can apply even to your stock investments. Some stock funds do generate a lot of trades and gains year in and year out because the portfolio manager strategy is much more active, a lot of buying and selling happening, whereas other managers or other strategies are more buy and hold by nature, and they tend to be more efficient. So those are more desirable investments to have in accounts that are taxable, so the tax cost can be lower than something that is perhaps less tax efficient.
And those techniques strike me, Naveen, as ways to build a nice foundation for a tax smart portfolio. What do you do to manage it after an investor is up and running, though?
Right. So why do I have dozens of people looking at this day in and day out? There's a lot of maintenance that goes into this. So once the account is up and running, there's a lot of stuff that we can still do to vigilantly make sure we're doing everything we can to be tax efficient over time. So some of it is just maintenance over time. As stocks and bonds rise and fall, we typically look to realign the portfolio to its long-term target. So after, say, a strong stock rally, a portfolio that started off as half stocks and half bonds might be more like 55%, 45% stocks. Bring that back to 50-50, which lines up with the client's goal and risk tolerance. We want to do that in a tax smart way, where we're perhaps selling off investments that are either at a loss or a small gain to buy other parts of the portfolio to bring it back in line. Similarly, if the client is looking to get some money out of their account, we follow a very similar mindset. How can we get the money to them without incurring a lot of gain? So here again, focusing on investments that are either at a loss or small long-term gains can be more tax efficient than just grabbing something willy-nilly out of the portfolio and selling it that way. So that's some part of the maintenance. Another big part of this is managing distributions. So towards the end of the year, in the third, fourth quarter, we start to get updates from different fund companies on their estimates of how much the distribution might be for some funds out there. And this can be helpful to look at for two reasons. One, if we already own a fund, we will then look at the potential distribution and think about, is this a strategy worth hanging on to? If it's going to be a large distribution and it's a fund that we're not as in favor of as anymore, perhaps it's something we do pull out of the client's portfolio and look for something else instead. Or the other way we can use this research is to avoid funds that have said their gains are going to pay out a pretty big distribution this year. So why not wait till the distribution's been paid out before potentially acquiring that fund? And the last thing I'll cover on this list, this glorious 8-circle strategy here, is tax loss harvesting. And tax loss harvesting is a strategy an investor can use to basically take advantage of market volatility or the ups and downs of the market to potentially generate some tax benefits in the current year or in future years for themselves.
So let me actually sneak another question in here, Naveen, because we got a lot of viewer questions when folks registered about tax loss harvesting. So can you just spend another minute or two walking us through how exactly that works?
I can, and this will be a preview. So I encourage you to discuss this with your tax advisor, do your own research on this as well. You can have a lot of little technical concerns around this, but at a high level, the general idea is the tax code does allow investors to use realized losses in their portfolio to potentially offset tax liabilities in other parts of their lives. So let's take an example to bring some this to life and get away from some of the jargon I'm using. All right, so let's say an investor who buys a certain stock at the start of the year.
And this sort of ties into the estate plan.
Research on this as well. You can have a lot of little technical concerns around this, but at a high level, the general idea is the tax code does allow investors to use realized losses in their portfolio to potentially offset tax liabilities in other parts of their lives. So let's take an example to bring some of this to life and get away from some of the jargon I'm using. All right, so let's say we have an investor who buys a certain stock at the start of the year, and after the recent sell-off, they're not as enthused about owning it. So they sell that stock out of their portfolio. And by the time the trade settles, they have realized a $5,000 loss from that investment. So that is unfortunate. However, from the tax code perspective, there is potentially some benefit to be had from that. So one, the first $3,000 of that loss, the investor may use to offset ordinary income in the same tax year. So the first $3,000 is available only up to $3,000 to offset ordinary income. The balance of that, so of the $5,000 loss, let's say $3,000 was used to offset the income, there's still $2,000 left. That leftover $2,000 can be used to offset realized investment gains in either the same tax year or at any time in the future. There's no expiration date on that portion of it. So that's how using tax loss harvesting can help with market volatility, actually get some benefit for the investor. Now, with the proceeds from the sale of that security, the investor is more than welcome back into the market. But here's where they have to be careful and thoughtful about it. And here's where talking to a tax advisor can be very helpful. The rules do say you cannot just buy the same security back too soon, or essentially the same security back too soon. And there's time frames around this and different limitations, but generally speaking, one can invest in a different part of the market, or perhaps a different asset class altogether without as much of a concern there. And therefore, they're still invested in the market. The makeup of their portfolio perhaps hasn't changed all that much, yet they've been able to harvest this loss and use it to have an actual tax impact either in the same calendar, or I should say same tax year, or in the future at some point as well.
Got it. All right. Thank you for that walkthrough there. Sandy, I want to shift to you now and ask a little bit about taxable gains, because certainly some amount of taxable gains are going to be unavoidable. So knowing that, accepting that, what strategies can you talk about that might help us manage those investment gains?
Now, so, many times a smart investing decision does require the sale of that appreciated position, resulting in the gains and therefore, unfortunately, an increased tax bill. And as Naveen mentioned, though, if we have maybe some losses we've already recognized, we can help offset that. Another strategy, maybe for those clients that are charitably inclined, is making a charitable contribution. However, due to the current level of the standard deduction, a lot of our clients aren't able to itemize and may not receive the full benefit of that charitable contribution. So in those strategies, though, we can use a strategy called bunching, when you can make several years of charitable contributions in 1 year to a party that's sponsoring a donor advised fund, also known as a DAF, such as Fidelity charitable. You get the potential deduction when you make the contribution, and this higher level of charitable contributions can get you over the standard deduction and therefore help offset the income tax bite from that gain. And in addition, now the client or donor has a ready reserve of charitable funds to use to support their charitable causes either now or in the future. So when contributing to a DAF, long-term appreciated securities are a great asset to gift, since you'll no longer have to pay capital gains tax on the sale of the security, a benefit whether you itemize or not. So as an example, if you make a contribution of that security to the DAF, typically it's sold right away, and then you have reinvestment options. So if you have highly appreciated stocks in your portfolio, like a lot of these tech stocks that we hear about all day long, this could be a great strategy to consider for diversifying out of those positions. Another strategy, and this sort of ties into the estate planning for those clients looking to diversify out of a concentrated stock position, is a charitable remainder trust. Once the charitable remainder trust is set up, you can gift appreciated securities to the trust. When you set it up, you select an annual payout rate.
Of different types of stocks funds, US international, maybe some bond exposure as well. So a lot of the positions can stay where
To maybe sponsoring a friend in a charity race. It's worth noting that there are donor advised fund sponsors who really don't have any minimum balances and don't have any minimum amounts that you have to contribute to the account.
Got it. One more quick follow-up for you, Sandy, if I could. At the risk of stating the obvious, managing tax brackets, trying to predict where you're going to land can be tricky at best, particularly for folks who've got these
tax impact of those trades, rather than doing them all in the first few days of the account, transitioning from wherever it is into the tax managed strategy that our investment manager
Like this, As I mentioned, you need to get your tax advisors, typically CPA attorneys, involved. You really don't want to wait till the end of the year to implement this strategy.
And thank you for acknowledging the complexity of all this. I really do think that that's something that I'm sure people watching right now are trying to wrap their heads around. It's complex to begin with and has the potential to get even more complicated when you're working, Michelle, for example, when you're working with a family that's got multiple retirement accounts plus some non-retirement accounts. How do you help herd all of those cats?
I love how you said that, Jim. So this is where I get to selfishly talk about one of the most exciting things that I think that Fidelity does right now. It's called the Unified Managed Household. And really what that is, if I could sum it up in one word, it's holistic. Okay, this is where we're going to look at your different types of accounts: Roth IRAs, traditional IRAs, non retirement accounts. We're going to look at them
Advisor or tax professional can help you weigh one.
We're going to hold some of those inefficient assets in your IRAs because they are tax sheltered. We're also going to hold some of those efficient assets in your taxable accounts. So where we're going is we are meeting the goal level asset allocation. However, we are doing it across multiple accounts so that you are not only meeting your risk level, but you're also doing it in a tax efficient manner.
On this topic as well, how do you and your team help clients move to a more tax efficient strategy without potentially incurring those big gains?
Because they are tax sheltered. We're also going to hold some of those efficient assets in your taxable accounts. So where we're going is we are meeting the goal level asset allocation. However, we are doing it across multiple accounts so that you are not only meeting your risk level, but you're also doing it in a tax efficient manner.
On this topic as well, how do you and your team help clients move to a more tax efficient strategy without potentially incurring those big gains?
Yes, this is potentially a stumbling block for some investors who may be considering these strategies. And they open up their account and they shake their head saying, "This can't be for me. I have so many positions here I've held for a long time and they're at a sizable gain. I can't afford for someone to come in, sell everything off, and then start from scratch." The good news is the team here has had decades of experience managing accounts and transitioning accounts into alignment with perhaps our
to Roth IRA.
Is the qualified
that our investment man thoughtful about not investors
retirement accounts, Roth IRAs, and perhaps non-retirement accounts. So what we're going to do here is we're going to reallocate so that asset location is very critical here. We're going to be tax smart. We're going to hold some of those inefficient assets in your IRAs because they are tax sheltered. We're also going to hold some of those efficient assets in your taxable accounts. So where we're going is we are meeting the goal level asset allocation. However, we are doing it across multiple accounts.